Hey guys, Freaky Finance here. Today we're going to do a fun one, Albertsons. We've actually done this in 2020 and we were able to ride up in groceries because Albertsons just went public then from private equity. Albertsons is great for this example because it ties in defense, which we've been talking about for probably the last, 2 months now. And just slowly getting more defensive, and there's another name like that, and it's also a loser. So it also ties in the last week's video with Target, where these are losers in the year. And people are usually around September and October are looking at selling them for tax purposes. So you're getting both things at once with this idea, and I like that. So anyway, we're going to jump into Albertsons with a slightly different take. Last time we focused a lot on the IPO and the opportunity there because it was around 10 to 14 bucks a share for a while. And then it rallied with most things after the vaccine. But anyway, Albertsons has a lot of types of retailers. So Safeway, Albertsons being pretty big. Quite a few different brand names in Texas. They also have Vons in California. You have Shaw's in the East Coast, Northeast. That's kind of just the footprint overall. This is also all the brands they own. So Safeway, Albertsons, Vons, Acme, Shaw's, Tom Thumb. So quite a lot of different names. And in terms of the sales mix over the last 3 years, these are from the annuals, you can see a slow trend change. Basically, pharmacy is slowly growing bigger and bigger as a part of their sales. So that they've been pushing into pharmacy to try to get more sales. However, and we're going to see this when we go through the numbers, pharmacy is actually lower margin than groceries, which, we didn't think was possible. For the record, we haven't done too many groceries, but groceries margins are very low. But they also have the ability at the end of the day to push price if they need to, or at least they have been able to. If brands are pushing them around too much, they can usually find private label to take share and get them on their shelves and get a cheaper price for the end user. So there is ways that grocery stores have been making more money over time. And it's also a very stable business. There's fewer things more stable than groceries. So that's worth bringing up as well from a defensive point of view. But that's a trend that's happening as pharmacies slowly grow. And you can see the other ones are very slowly growing. Like Fresh is barely up year over year. Non-Paris was up $1.3 billion year over year. So very small increases for a company of this size, right? 80 billion in sales. In terms of the longer term trend, if you zoom out even further, this is from the last time we looked at Albertsons 5 years ago. And here you can see pharmacy was only 8% of sales, 7% of sales, right? Now it's all the way up to 12. It doesn't look like much, but it's a slow trend, and it's important because it helps you understand where the revenue is largely coming from, the growth, but also why there's margin pressure on the gross margin line. So that's worth bringing up right away. You're going to see that when we go through the recent trend of the last 5 years. The AI picks up on that as well. Another thing I want to point out is just how steady the cash flow from operations is. Again, it's a big grocery store. You can actually see net income is not that great. That basically a lot of it comes back from depreciation. So anyway, you can see 2.8, 2.7 billion, relatively steady. They've actually been reducing CapEx again. One of the interesting things, and you'll see that, I have the when they IPO'd. So here you can see CapEx being very low, 1.3 billion, 1.4 billion. And basically what I think happened is that private equity was trying to get out of Albertsons, reduce their stake, and they wanted it to look as good as they could in terms of free cash flow. And so they probably pulled back on CapEx more than they should have into the IPO. And then Albertsons like, okay, now that we have more cash, we got to start actually investing more in our stores again. And so you saw that go from 1.4 to 1.6 all the way up to 2.1 and 2, right? So big increases in CapEx for that period. And now we're starting to see it normalize again. So that's another thing I like to look at is CapEx going up or down year over year, right? Because this is technically more cash flow than last year, even though it doesn't look like it. So that's something I wanted to point out as well, is the CapEx cycle, and also how private equity tends to do things. Very focused on them, not the long-term success of the business, which is another factor. The reason why Albertsons is likely cheaper than other grocers is because they still have, to flip to this really quick, you can see Cerberus still has a 26% stake in Albertsons. So it's still a large stake from a holder that's already, long-term is best interest to slowly sell out, right? But you don't know that, but that's just something that could be overhanging the stock. What else? I also like to look at how high the rank is. So there's not a lot of people that believe in Albertsons. It's not like it's a big position. Some people have a decent amount of weight in it, but they're small, and you're seeing selling on them, which is nice. So, and again, you can see the average prices are lower than now. So it would imply that people are just trimming some for tax loss purposes. And that's kind of just a theme that I look at. Anyway, in terms of the share price, one of the reasons why we're doing the video is because it's a loser this year, and it's defensive, and it's finally back down to where it was in 2021. 2020, which is nice. So we're in that 16 slot range, 16 handle, which I kind of like to look at it. That actually hit my alert again. I was like, and the alert was 5 years old. I was like, oh my God. So anyway, it's all the way back down here. The business has slowly grown. The business has slowly gotten better. It's pay down debt slowly. So that's another thing I look at here. Well, let's jump through the numbers really quick. Before I do that, I should show that I do own this one. I own Albertsons, down about 4%. I wanted to share that. And I think this is just one that I was trying to look at, things that were selling off a lot on Friday to try to start positions in some again. But anyway, just wanted to share that I do own Albertsons, starting a position, not a full-size position yet. I just slowly average in. Maybe we'll talk about tariffs again next week if the markets are still down, but it's going to be akin to what we talked about in April. That will be the same strategy. Here you can see the last 5 years. It's all generated from AI. I basically just have a template and I make it, fill it in, put their commentary for Albertsons this time. So anyway, you can see a slow trend up in net sales, largely driven by pharmacy, but there is slow grinds up in the other areas as well. Albertsons basically over-earned into that 2021, which is why we did the video back then, because we knew they were basically essential services and the mom and pops got wiped out for food and restaurants, right? And so that takes time to get back it and start taking share again. So anyway, that was why we were in that and why we did the video, and then we sold it, and now we're back in again. You can see the slow grind up. You can see, however, gross profit has been relatively stuck, and you're seeing SGA pressure. And this is the main reason why I think you're getting the valuation coming back down. There's also the Kroger's and Albertsons merger that failed, that we'll talk about in a second as well, which adds a little bit of interesting catalyst to this idea. But anyway, that's kind of what I think the squeeze. Here you can see depreciation slowly creep up. And again, I think a part of that was because CapEx was underinvested going into this. So when they start increasing CapEx, depreciation ticks up year over year. This might actually start, you can kind of see the rate of change already at decel, and that would be what we saw in the CapEx on this cash flow statement as well. Operating income relatively steady in the long run. You can see it's normalized again. However, one of the great things is, even though you're like, oh, they made $40 million less year over year, they paid $35 million less in interest year over year, which is very nice. And that's the consistent bright spot the AI talks about. These are all AI's words, but declining steadily over a period as a result of the multi-year focus on deleveraging. What else? Fully diluted share count's been relatively flat, so it's not a big share buybacker, unlike the other companies we talked about, like Bath and Body Works. Here you can see the valuation finally coming back down, right? The time when I was looking at it was around $17. So you can see it's back down under 10 billion, which is nice. It got as high as 16. Inventory is relatively steady. The AI is right here. It's key strength. They've been managing it very well, which is a hard thing to do, but groceries I tend to find are easier because the demand is usually very steady. But it is hard sometimes with supply chains. Like, how do you meet that steady demand, right? If some products are no longer being shipped on time, which happened during COVID. So anyway, here you have indebtedness slowly going down. They've also been able to get lower interest rates, which is very nice. We'll talk about that in a second as well. But basically, they refinance at a lower rate than what they're currently paying. So they're getting better rates, even though the markets, basically the equity market's saying the company's worse and the bond market's saying the company's better. So they're able to raise money to say at 5% and pay down debt at 6%. And the debt that was at 6% was due in 2 years, and they're able to reissue another 7 years out at a cheaper rate, which is, it's basically telling you the company's less risky than it was when they IPO'd. That's what it tells me. So it's kind of fun to see that divergence when the bondholders are like, yeah, we'll take a lower rate, and then the equity holders are basically back down to almost the IPO price or below it now. It's worth pointing up as well. You can see, what else should we point out here? The cash flow, we already showed it in the statements, relatively steady. You're seeing the CapEx start bottoming or topping out, which is nice. Buybacks are show up now and then, but largely the cash flow has been going to debt pay down. And it does pay a dividend, which is important as well. I think it's only like 3 or 4%, but still something for a pretty safe company, especially with the PEs around 10 or lower, depending if what you believe. AI actually has some interesting valuation metrics for this. But anyway, you can see the growth rate come in, so it makes sense that the multiple comes in. Here's the pressure in the gross margin from pharmacy sales. We'll also talk about the lower margin digital. They're actually growing very well in digital, but they're incurring extra costs to do so. You can see GAAP EPS wasn't even that good last year, so 2025 is actually an easy comp year, which is another thing that I look for when I'm trying to get into a position. And you'll see that when we go to the most recent quarters, is that my numbers don't look that bad at all. And part of that was because they were bad last year. Or not bad, but not great. Here's this more color on the call. Digital sales incur higher fulfillment costs and delivery costs, while pharmacy sales carry inherently lower margin than traditional grocery. SG expenses have been increasing, as well as to build out digital and omnichannel capabilities. So they have been teching up a bit as well, which is long-term efficiency, short-term pain because you have to expense it. But that's another thing that's happening. The AI, I thought this was funny. They said Albertsons only had 20% private label. We did a video on Target. We kind of showed like most people are in the 30s now, or at least high 20s. I was like, is that true? And then I pushed a bit more, and then it turned out it wasn't true. So I was like, I don't know where they got 20.5 from. Maybe it was just these current 3 brands instead of all their brands. I have no clue. But the latest quarter, they said something like 25% or something. Anyway, there's still room to grow though, right? Kroger's is 27, Walmart's over 30. So the private label, again, they make 9% more on the same unit sold. So like if you buy their private label, they make more money than if you bought a Pepsi product on their shelves. Own brands. So this is the AI's growth ideas. I just asked, well, if you were in charge of Albertsons, what would you do? And basically it's like the two other things that they're doing anyway. The third one, I was like, okay, unlock real estate value. But obviously the AI's raw private equity, because all the private equity guys basically tell them, hey, sell some of your stores so you don't own the land anymore, raise the money and buy back shares or pay down debt or invest in a business, whatever it is. And that can be a good thing at certain times. So, but the AI seems to be recommending that almost every time, which is sus for sure. Anyway, in terms of property, it's not like as clear as Target. So they do own or hold ground leases on approximately 40% of their stores. You can also, but it's not as clear like Target owns almost all of them. It's not quite that same value play in terms of property value like a Kohl's or Target, but it still has a lot of stores that it owns. In terms of the density, you can see California's over-indexed, so 585 in California, which is also probably another reason why it was slower growing than other grocers, because the population hasn't been growing as quickly as other areas like Texas. You can see the populations are now very close, but they still have half as many stores. Washington, they're over-indexed too. And again, places like Florida, they're under-indexed too in that southeastern United States. But you can see Northeast, they're actually relatively there. So that's worth bringing up. In terms of the Kroger versus Albertsons, so one of the reasons why the share price went as high as it did is because we're going to plan to get acquired by Kroger at what I thought was a pretty good deal for Kroger. Anyway, it got blocked by the FTC. Basically, they're accusing each other now, and they're basically breach a contract. You agreed to acquire us, and then you failed to do so. Albertsons basically claiming they didn't do their best effort to just secure necessary regulatory approvals for the deal to close. So kind of like good faith, they alleged buyer's remorse, flawed divestiture. Basically, the FTC asked Kroger, if you want this deal to go through, you got to do this. All right, and Kroger said no. Or at least didn't fulfill what everything the FTC wanted for the deal to come through, ignoring regulatory, so failing to meaningfully address the feedback and concerns. So if they have proof of that, that would obviously help their claim during the discovery process, which is ongoing, and then rejecting better options. So anyway, to bolster its case, Albertsons claimed it offered Kroger $800 million in financial consideration to improve the divestiture packages to increase the odds of approval, which Kroger ignored. So Albertsons will likely have proof of that because they're the ones who did it. So that's something interesting. And then you have the contractually obligated $600 million termination fee. So when you decide to buy somebody, there's usually a termination fee because you have to act in good faith and align companies. So this one, I actually view the termination fee likely to be paid to Albertsons, $600 million, which isn't small. It's not crazy big because the company's worth $10 billion, but it's still $600 million in cash, which the company could do something with, which I think is a likely outcome. I did ask AI after the fact, but just based on contract law and my understanding of it, that it's more likely because it was signed at the time by both parties. And they both were under the impression that that contract would work or not work. That's what the termination fee was for. So the fact that it got terminated, regardless of the reason after the fact, it should get paid out to the person because both parties signed it at the time. Secret misguided campaign from Kroger. Basically, they're saying Albertsons went behind their back. They're communicating with other people to try to get bids. Basically, they're saying Albertsons wasn't acting in good faith, and they undermined the divestiture buyer. And then they also say Plan B lawsuit. So because they filed the complaint so quickly, like I think it was within days, they're saying they never really believed in the deal because they already had a Plan B. And that's a harder thing to argue because I would like management to have a Plan B if Plan A fails. But yeah, I mean, I kind of understand the point, right? Your odds of Plan A are lower if you have a Plan B. But anyway, I just call it proper risk management, which is what Albertsons will argue, and I'm sure. I mean, this is harder to prove. So I think in terms of who's likely, like the AI thinks, I think it's like 65%. I asked it to give me a number, but yeah, probably 60% of Albertsons win. A more likely outcome is a settlement where Kroger pays $600 million termination fee and a potentially smaller amount in damages to make the lawsuit go away. The AI thinks the objective facts are on Albertsons' sides. The counterclaims, however, are devastating if they're able to prove, right? If they're able to prove that there's a secret campaign to undermine the Kroger's deal at the Albertsons side, and that would be a clear breach of contract by Albertsons. So it'll kind of depend on that, and we don't know how that's going to go. That's another $600 million for Albertsons, potentially, or not. Obviously, when a share price just got nothing but down for the year, it's kind of telling you what the market thinks. The probability is not as high as what the AI thinks, or at least that's what I'd articulate. Anyway, you can see in terms of share, which is one of the fun things. And I was actually surprised that, according to the AI, Walmart only has 23.6% share in grocery. Maybe, I mean, a lot of people are loyal to grocery stores, but as someone younger, I mean, every time I go to a grocery store, I know it's more expensive than Walmart for groceries. Like, it's very rarely that I see someone beating them on price. That doesn't mean there's quality or something like that. I mean, people go to other stores for just convenience, close, and I worked at Safeway, one of my first jobs. So, here you can see Albertsons only at 6.4% share, Kroger only at 9.2%. So even if they merged together, they'd still be dwarfed by Walmart. That was kind of the reason why. Right, and there's a lot of scale if they could merge. I asked the AI to time a legal battle, so they think phase 1 discovery is currently underway for most of 2025, and during discovery, the settlement's unlikely, as both sides want to see the strength of the evidence before settling and negotiating. Phase 2, they think, will be late 2025, so we're already in October 25, and early 26, which is exciting. And then phase 3 is the pre-trial preparations. And pre-trial usually has a lot of expenses related to lawyer fees and preparing witnesses, right, and the legal strategy. And it's the most common window for a settlement they'll have to conduct if they want to pursue or not and incur all these legal costs, right? If the probability of success is low or higher, which will be probably based on what they find in discovery. That's what I'd like to point out. And the place is the most likely window for a resolution squarely in the first half of 26, so another good reason to do the video in late 25. What else should we say here? The implied forward ratio, you're not asking for a lot. The AI thinks consensus EPS is 211, 212, or 220, right? So very slow growth. This is kind of what you see in groceries over a long time. Over a long period of time, it's a very slow EPS grower. It pays a steady dividend, and that's kind of what it does. Anyway, you can see the implied forward P ratio is very low, cheaper than China or Argentina companies. So that's something I also like to look at. Like, the valuation's obviously there, but cheap always goes cheaper. You never really know how cheap someone will sell you something. So at least it's 2 turns cheaper than its average to itself. Albertsons always traded cheaper than other grocery stores. I think partially because it's newer, because it's new to the public markets, and partially because of the private label overhang. Or private label. I mean, there's a private label overhang, but there's also the private equity holders that still own a lot of the company. Anyway, you can see the PE in terms for Albertsons relative to other grocers like Kroger, Sprouts, Walmart, Target, Costco. Materially cheap for grocery in general. And now we have the analysts chasing down estimates after the fact, right? So I look for analysts are saying, oh, this company's now only worth $21, used to be 23, right? And they're basically just following the price down. And they do this all the time. And that's another thing I look for when I'm looking to buy. Is people are just resetting expectations, they're guiding down, even though the business is not guiding down. It's just the analysts are guiding down slowly, which is another thing I look at. And basically, they just follow the price. They don't really have, in my mind, real value add. I mean, that value add is me seeing it, so I know I can start looking at it. Anyway, here's another example of the favorable refinancing. I kind of talked about this, but in March 2025, Albertsons issued $600 million at 6.25, which is due in 8 years from now, to pay off $600 million at 7.5 due in 2026. So not only are you reducing your debt, but you're pushing it out. And that's something you usually don't see when equity is going down as much as it has. So it's kind of like, okay, the bondholders are fine. Technically, your interest savings are going to continue because you're refinancing at a cheaper rate. And I think part of it was Albertsons' interest rates were higher, partially because they were likely in the private market, right? And now they're in the public market. You can see the history longer. There's higher standards in public markets. More transparency, and that likely makes bondholders be like, okay, we can charge less. Now interest rates are also going down, right? So that's another reason, and their forward curve is likely to continue to go down, in my opinion. But that's just what I think, and this is another reason why I'm like, okay, if the bondholders are deal with this, it's obviously less risky than it was last time I went to get financing, right? And well, the equity is cheaper, which is nice. So I like that disconnect. I do have a good loyalty program, which is doing very well. 24% increase in 2024, and 22 and 23. They actually have 45.6 million members on the loyalty program. We talked about the loyalty program and how much value that adds because they get more information from the customer from that location. They can target better customers better and get more sales, convert to more sales and more traffic, and basically match the products to the people better. And we've seen this been true over time, and it does add a lot of value to these guys. And that will also only improve with AI. Anyway, in terms of the outlook, sales growth, they actually increased the sales growth, but they kept EPS the same, right? So you raise guidance for the revenue, but you keep EPS the same. It's like, okay, so you're seeing margin pressure, or maybe it's more delivery fees because they're pushing online more, right? Because delivery is growing so well, or maybe pharmacy is outgrowing the other ones, or maybe there's wage pressure because they just had union signs, right? There's a union pressure here as well, which we'll talk about in the transcript, which is what I don't like about Albertsons. Probably the main thing is the union. but largely unchanged. We're just getting a cheaper price, technically better. What should we talk about here? Here, I just wanted to point out how steady it is year over year. So in the most recent earnings call, you can see comprehensive income is almost flat year over year. It's flat in terms of EPS because they've bought back a little bit of shares lately, which is another thing you like. But again, it's not a big value driver for the company. A lot of the cash flow goes back to CapEx, and then it goes to dividends, and then maybe some goes to buybacks, right? The digital platform grew to 25% again, and now it's 9% of grocery revenue. So this is where they're growing a lot, is on digital, which is good, but it's also bad for margins because they incur more costs here on e-commerce currently. So it's good and bad. That's what I want to point out here. It's a little bit of nuance. The second digital program is loyalty. Again, it grew 14% again. Now it's at 47 million members in the first quarter of Albertsons. Members are engaging more frequency, redeeming features, spending more with us. Case in point, 30% of our households are now electing the cash off option, reinforcing the customer's desire for immediate value, right? And then the third digital platform is pharmacy and health, which grew 20% year over year again, right? So more pharmacy, more immunization, and then they can cross-sell other things. That's the idea of why they're trying to bring pharmacies into groceries, right? Get them to buy other things while they're there. Increase the frequency of traffic, and it also does technically increase what you offer to the customer, right? More reasons for you to go to your store. What else did I say here? Basically, just adjusted EBITDA growing higher than in fiscal 2026. So they're saying things are actually slowly getting better incrementally, which again is not indicative where the share price is. It's getting worse as we talk, which is another thing I like. And then in terms of own brands, they're proud of their own brands that we have. They're not satisfied with the penetration we have. They're leading to that into Q2 and the rest of the year. And that's, in my mind, a value unlock. It's always been under-penetrated for its own brands relative to the others, so I don't know if Albertsons invested enough in their private label brands as much as other grocery stores have. It's the opportunity for growth. It is growing. It is higher margin, so if they can do this to try to offset the pharmacy and the digital sales growth, I think this would also re-rate higher, right? Not just from a revenue growth standpoint leading to multiple expansion, but from actual margins expanding on the gross margin dollar line, which again, it hasn't for a while, right? It's been kind of stuck, very stuck, even on the latest quarter, right? You're basically down 600K, right? And you still have your inflation and you have your union costs, right? And they are saving money on interest and other things, but you can see overall it's just kind of stuck, treading water. Similar, actually eerily similar to Target and Bath and Body Works, right? Just similar story, just treading water. And we're getting a better price than we ever have, like 20 or 30 or 40% cheaper, right? Which is nice. So there's a lot of things here at Albertsons to like. And again, it gives you that factor of defense and a loser in October, which are things that I like right now. And maybe we'll talk next, if things sell off again, like on Friday, like they did from Trump tariffs, it'd be good to do a video on that. So I'll probably consider that and kind of how I play that and how I go back in and out and look for things and things. I'm like, okay, that's an overreaction. One of the clues I'll give is what you could do nowadays is just download your holdings and send it to AI, especially Gemini and Deep Research, and be like, what are my biggest exposures to tariffs increasing 100% from China? And then it'll list them and maybe to categorize it into high, low, and medium and stuff. And it's pretty good how quickly it can organize that. Like it's 15 minutes, whatever it take me, more than a week, right? So anyway, have a good rest of your week. And I hope you enjoyed Albertsons. Take care now.